the problem that real estate professionals run into is they're doing the exact thing you're talking about. They're killing it their first couple years. Well, they kind of hit this wall at some point, and that wall basically is debt to income ratio. And the lenders start looking at it and, hey, are we over leveraged? Are we, what are we looking like? So that's where good tax planning and strategy and sitting down with professionals.
You're checking out the Investor Shed podcast with Nick Beveridge and Jeremy Kitchen. They're on the path to financial freedom and they're taking their community with them. Stay tuned for the best free real estate investing advice on the internet.
Well, hello, everybody. Welcome back to the Investor Shed podcast. Boy, do we have a good one.
We got a good podcast for you, ladies and gentlemen. I'm Jeremy Kitchen, co-host of the Investor Shed podcast with my beautiful co-host, Nick Beveridge. We have Tom Robinson on the podcast. And speaking of Tom Robinson, he's the master of all things tax professionals. I love talking with Tom. I feel like every time we get on these professionals on the show, I just learn so much. And it's really cool to be in the same room with them.
You got so much energy on this podcast.
I got a lot of energy going on this
You're
podcast.
just like, woo, tax savings. Oh, yeah.
I love it.
Yeah.
Because as business owners and entrepreneurs and real estate investors, like taxes are going to be one of the biggest expenses that you have.
Yeah. And we don't just talk about taxes. We also talk about asset protection, different entities used. We talk about trusts. We talk about being a real estate professional versus not being a real estate professional and investing in real estate and the differences between the two. A lot of good stuff. It was so good that we lost track of time. We only went through about half of what we wanted to talk about. And we were at an hour and 10 minutes. So I think we went an hour and 15 on this one, one of the longer ones. And we're going to call it part one because we're going to have a part two in just a few weeks.
Yeah. And if this stuff interests you, stick around, listen to the information because, again, Tom is just such a knowledgeable dude in the industry, willing to help and willing to run through these scenarios on, what if you're a professional, what if you're not, and how to structure your entities appropriately. So it's a great episode. Nick, what kind of food should people be indulging in this episode?
Man, I would say Costco pizza. Yeah,
I would
because
too.
you can get a lot of pizza for $10.
Yeah. What if you're not a Costco member?
Ooh, well, become one. It's only $50, $60, whatever. Then you get a $10 pizza.
This is not endorsed by Costco, but if you want to endorse us, Costco, hit me up on my celly.
Costco, where you at? We're right here. Everybody, welcome back to the Investor Shed podcast. I'm Nick Beveridge here with my co-host.
The man of the hour in the office with Nick Beveridge, Jeremy Kitchen. And today we have a very special guest, our tax professional favorite, Tom Robinson. Tom, how are you today?
Hey guys, I'm glad to be on the show, and happy birthday to the Marine Corps and happy Veterans Day coming up to all the veterans.
Yeah, definitely. Happy Veterans Day tomorrow. Let's celebrate today.
That's right. It's a big holiday, so we all know about that. Tom, why don't you just tell us a little bit about yourself and what you kind of do in the real estate industry?
Yeah, so again, thanks for having me on the show. A little bit about myself. I started doing taxes pretty early. I got a job at a tax office at 17. It's not something you really set out to do and be like, yeah, when you're a kid, I want to go and do taxes. Like, my kids still don't know what taxes are. So I steal some of their ice cream every once in a while and be like, hey, this is what it's like to get taxes. My job is to protect some of your ice cream going out to other people. So yeah, I started out pretty early at a tax office. Realized pretty quick that I kind of had a knack for it. I got my tax license at 18, was manager of the firm that I was working at by the time I was 21. And here I am all these years later, owning my own business and representing North Idaho and most of the rest of the country in taxes. So yeah, one of those things.
Yeah, like you said, Tom, like a lot of people don't actually strive to be tax professionals when they're kids. Like I didn't even know about taxes until I was pretty much in my mid-30s. I mean, I knew about them, I knew they came out, but I didn't know how they work. And to be honest with you, I really still don't.
Yeah, and that's kind of one of the big passions of mine. A lot of times I'll go into the schools, high schools, stuff like that, because it's not really taught. Like, what is the difference between a W-2 employee? What is the difference between being self-employed, stuff like that? it's not really something that's kind of as well known as it should be, and kind of how our tax system works, for sure.
Yeah, and I'd love to, before we dive into the actual like the real estate investment side of things, can we chat just a little bit about the little known facts about taxes and what people maybe assume automatically? I hear this a lot from most people, like when I make a bunch of money on my tax returns, or they'll throw out these phrases as if they're actually making money when it comes time to get their tax incentive. Is that true? Are they making money sometimes, or are they just getting money back, or is it a mix of both?
It's kind of a mix of both, and a lot of times what's kind of funny is a lot of the times I hear I make the exact same amount of money as my coworker, and I don't get near the refund that they do. And so each tax situation is completely different. So it depends on what goes on in your household. Is your spouse working? Are you working? Do you have your own house? Do you have different deductions on your tax returns? Do you have kids? So all of those things kind of factor into taxes and basically, draw that big picture. So the way our tax system works is we have different tax brackets, and that's kind of a misnomer from what a lot of people think as well, because the way they think, all right, I'm in the 22% bracket, all of my income tax is now taxed at 22%. The way it actually works is it's kind of a stair step type of deal. So the first, let's say $20,000, that's not the exact tax bracket, but let's say the first 20,000 is taxed at 10%. That doesn't mean at 20,000 $1, the next dollar puts you into that next tax bracket. That dollar is in that tax bracket, but you also have different things such as standard deduction or itemized deductions and different credits that shrink your overall tax picture. So that is what you call your effective tax rate, and that's what you actually pay tax on. Once you start making a little bit more money, there is what's called AMT, alternative minimum tax, and that's the government coming in and saying, hey, you made this much money, we feel that you need to pay this much tax. So it really doesn't matter on some of the credits and some of the deductions you're taking, you're still going to pay that much tax because of AMT.
So, can we talk a little bit about the different types of, like, what's the difference between a return and a credit, and maybe other terms I may not be familiar with when it comes to getting a check from the IRS?
Yeah, so you have two different types of basically credits. You have your refundable credit and your non-refundable credit. So a refundable credit means you can actually get back more than you put into the government. So if you qualify for child tax credit or earned income credit or some other ones, it's actually dollars in your pocket. So let's say you have a single mom, she's making $15,000 on a W-2. She has a couple of kids and she doesn't have any money withheld from her taxes. She can actually still file and still get a refund from taxes because of the refundable credits. The non refundable credits basically will offset income, and basically you won't get the dollars in your pocket unless you have the withholdings ahead of time. And then one other thing that I always like to kind of get into is kind of the difference between being a W-2 employee and being self-employed. That's a huge one, and a lot of people like, hey, I opened up a business, it's really awesome, I can write off all of these things, but at the end of the year I'm getting killed in taxes. Why is that? Well, the reason why is self-employment tax. So if I go back to a W-2 employee, they're basically paying three types of tax depending on what state they're in. Sometimes they pay four types of tax, like in Ohio, you have city tax. But for the most part, people are paying three types of tax. They're paying federal income tax, state income tax, and they're paying what's called FICA. FICA is basically Social Security and Medicare. And when you first get your first paycheck when you're 18 or 17, and the state of Idaho, it's 14. What people are like, always like, hey, why am I not getting all that money? Well, that's FICA. That's the Social Security and Medicare. It roughly comes out to a little over 7.5%. And what that is your portion of Social Security and Medicare. But what people don't see is your employer also matches that FICA. And so they're paying additional, let's say 7.5% for easy math on your behalf. So you have 15% taxes being paid to FICA tax, Social Security, and Medicare on your behalf of each employee. Well, when you're self employed, you have to pay both halves of that FICA tax, which is Social Security and Medicare, so it comes out to 15%. So now no one's withholding any taxes from you because you're self employed. So you still have to pay the federal, the state, and you have to pay that self employment tax of 15%. So definitely a huge deal, something that people need to plan for sure.
Yeah, and I learned this the hard way. I mean, I heard it was expensive to have employees, but good God, it's really hard to try to account for everything that an employee will cost you if you're not running a profitable business. And you get to see some of that firsthand, don't you, Tom?
Yes, sir. And I was just going to say that I had a client that literally come in yesterday. They have a lot of part-time subcontractors that come in, and he's gonna basically hire them full-time and make them employees. And we're kind of running down the expenses because not only the employer taxes, which is an additional 7.5% that you wouldn't pay a subcontractor, you also have to pay workers' comp and unemployment insurance. So if you're adding workers' comp, especially depending on the field, that's a huge expense. Clerical, not so much because, there's not a whole lot of risk. But if you're a construction company or if you set up a flip company or you're doing something like that and you're hiring somebody to hang drywall or to do roofing or to do some general contracting work for you, your expenses just went way up because of unemployment and because of the workers' comp.
Yeah, I did it for like 2 years with contractors, and it was still so hard for me to figure out what was my actual cost for sending a guy out on a job for half a day. If I'm paying them 35 bucks an hour, I think I calculated once I'm really paying them like 45 bucks an hour or more. And that's sometimes it's even more than that if I forget to, yeah, like you said, include the workers' comp and unemployment insurance. And it can just it could be a real mess if you don't know what you're going to anticipate going forward. So is he still going to go through with hiring these guys?
Yeah, it's something that he has to negotiate with the subcontractors because now they're going to have a more stable paycheck. They're also going to have some paid time off and some other benefits, but he has to put some of that cost maybe back on them, which is definitely a tricky situation. One other thing about that is depending on the type of job, too. Let's say you're doing a government job or a government project, you have what's called prevailing wage, which means that you're paying somebody a set amount of dollars that's determined by the government. And then that can go up a lot too, depending because that rate is locked compared to you just hiring your normal employee, because those rates will change too, especially depending on either the government or the union that you're working with.
That's
Okay.
interesting. I want to dive just a little bit into that topic real quick, Tom. So you talked about being self-employed and being a W-2 employee. You can be self-employed and be a W-2 employee of your own company, though, correct?
So yes, sometimes being self-employed and then giving yourself your own W-2, like if you're a sole proprietor, sometimes that can confuse some different organizations in the government. A lot of times when you end up putting yourself on W-2, it's, for different reasons and stuff like that. Because basically you're shifting one to the other. Most of the time when we see somebody who's self-employed who's going to end up putting themselves on payroll, they end up setting up a separate entity such as an LLC, treating that, or a partnership or an S corp, or treating the LLC as a partnership or an S corp. That's really when you see that division, because now you're separating yourself from the business and actually then becoming an employee yourself of the business, even if that's a managerial role.
So what are the actual pros to setting yourself up like that if you're self-employed? Why would anybody even want to do that?
Yeah, so remember, setting up an LLC makes your life just a little bit more complicated. But at the same time, like, there's a lot of pros and a lot of reasons why you would want to do it. One of the big ones right off the bat is liability protection. One of the things that you'll find once you're self employed, especially in today's age where people are so happy, is you want to protect yourself and you want to protect your assets. So at that point, separating the liabilities from your personal stuff is a huge advantage to make sure that, the risk is involved in any type of business is kind of mitigated. Let's say you're a real estate investor, you're doing a project at a job site, you hire a contractor. That contractor that you think is legit, they're bonded and everything else, but they show up to the job site and they're high and they run over somebody on the job site. You want to make sure that everything is protected. Obviously, you have insurance, but with an LLC or with a entity, you basically have a wall that kind of helps separate your business and some of the dealings there and then your personal. So that's a huge advantage, but there's also some tax advantages as well. So we talked about self-employed individuals and that 7.5% or 15% self-employment tax that we were talking about earlier. When you're an S corp, so if you're an LLC, you can choose to be different types. If you're an LLC or you set up and choose to be an S corp or set up an S corp, you don't have to pay self-employment tax. So you're paying 15% less tax on all of that revenue. However, there is a caveat to that is the IRS knows, hey, now you're not paying self-employment tax, so now there's more requirements, so you have to pay yourself a fair market value wage. What is that fair market value wage? Well, it kind of depends on the different types of business. It depends on revenue, but there's a lot of wiggle room compared to just being self-employed. So there's a lot of ways that we can show the income, meet the IRS guidelines, and still save a lot of money in taxes for sure.
Very cool.
So when you do something like that, do you have to show that you're working full time, or is part time okay?
Yeah, so honestly, it just depends on what you're doing and what you're looking at. So a lot of times people who are end up working for their own companies just put themselves on a flat salary and say, all right, my net projected income for the year is this much. This is how much I need to live. This is kind of what the IRS guidelines are telling me for somebody in my industry and what I would pay. And then they would give themselves a flat check. But the joys about being your own boss is if you have a dip, like right now, interest rates are super high. The market isn't as moving as well as it was a few years ago. So we don't need to show quite as much income now as we did 2 years ago because our profit margins are down. So you kind of control that flexibility with paying yourself when you're self employed working for your own business.
Okay. Just to go into a little bit too, because I think there are a lot of advantages of obviously running an S corp versus a C corp. Right now, I have a C corp for my media business. Just as an example, next year, like I would like to turn it into an S corp. Is that something that's possible?
It is, but it depends on when you set it up. It also depends on a couple of different things, but basically, there's statutes that you have to, once you convert your company, you have to wait so long to convert it to another one. And there is a kind of a hard process with the switching that over. Not too hard, but it is something that you can do for sure.
Okay. That's something I'll talk to you off the air, of course, about that to see if we can make that happen for next year. But I just wanted to make sure that I could do it. And another advantage, obviously, if you have an S corp and you're a sole employee of your own organization, you can set up a solo 401k. Is that correct?
Yeah, so anytime that you're an employee of your business, you can then give yourself some employee benefits. And it's not just strictly yourself. If you hire other people, you can offer those benefits as well. But yeah, so what does that look like? You can pay yourself retirement, you can pay yourself health insurance, you can pay yourself a number of different things, just like you were a employee of a big firm. It just kind of shrinks down, and there's different options that you can do as far as retirement for small business owners. You can do traditional IRAs, you can do what's called a SEP, which you can stash, I think, up to 16,500. The numbers may have changed, but
That's like a self-employment pension, right, Tom?
no, that's a simple. Simple is like a kind of in between traditional IRA and a SEP. A SEP, what you're talking about, you can stash up to $63,000 into that or up to 25% of your revenue. And one thing that I know, this is real estate investor related, one thing that a lot of people don't know, which is an amazing tool for people who are heavy in real estate, is you don't have to necessarily have your retirement in stocks and bonds, mutual funds, and stuff that a lot of people who are real estate heavy are kind of nervous about or shy away from or don't know as much. You can set up what's called self-directed IRA, and you can have real estate inside of your retirement account. There's a lot of rules. You have to see a specialist when it's regarding that, but basically you have to be hands off on the property. You can't manage it or you can't do some stuff like that. There is some rules on that, but yes, you can fund your retirement with real estate with some of those type of accounts. So definitely a useful tool.
I started that up this year, Tom. It's pretty cool. I've only done a couple notes out of it so far, but you got to plant that seed to make the tree grow. Anyway, it's cool. Like you can just use these tools to your advantages, and that's exactly where taxes come in with this stuff, right?
No, for sure. Anytime that you can, you know, mitigate the amount of taxes that you're paying, obviously you still need to pay the what's correct and what you need to, but yeah, anytime that we can legally shrink the amount of tax liability that we have is a good day for me.
Yeah. And one of the things that I wanted to bring up, because it's something I've realized over time that I have this problem where people ask my advice on a lot of things real estate related, and then we get into taxes, and I probably give the worst advice ever to people because I'm not a tax guy like you, and I just go off what I kind of know about myself. But I'm a real estate professional,
Hmm.
and sometimes I give advice assuming that everybody around me is a real estate professional. And it's a big mistake I make a lot. Can you talk a little bit about the difference between a real estate investor and a real estate professional and how that affects their tax options?
Yeah, so exactly what you're talking about. There is a difference. Real estate agents, by definition, are automatically real estate professionals, and different types of industries, property managers, and others are automatically thrown into that category of being a real estate professional automatically. But if you're a real estate investor and you're trying to get over that line, there is some guidelines on the IRS website that basically will lay out exactly what it means to be a real estate professional. And most of the time, it has to deal with hours and basically what you're doing with your day. So, if to meet the requirements to become a real estate professional, I believe the current rule is you have to have more than 750 hours of time in real estate. So what does that look like? What exactly are they looking for? So going to real estate investor meetings and meetups and stuff like that, such as like the REI meetings or meeting with real estate agents, looking at properties, looking online, all of that stuff counts towards that being a real estate professional. So what I would do is, if you're borderline on the fence, should I be a real estate professional? Should I not? I would probably keep track of hours and kind of detail it out a little bit more than what you think. Like, hey, I spent an hour, looking up properties, or hey, I downloaded PropStream and I spent so much time looking at different properties or stuff like that on there. So the more proof that you can have if you were ever audited to see, hey, are you really able to meet the requirements or not? I think that would be something to have great in your back pocket. But as far as tax implications, there's a lot of different things that separate the two. The main one that I see most often come across my desk is for real estate losses. So if you're a real estate professional, you can actually take your real estate losses even if your income exceeds the amount that you're allowed to take the real estate losses. So that is a useful tool for, let's say, a real estate agent. They're making 175,000. The normal passive income loss rules, basically, they're not allowed to take the real estate losses on their rental properties, and so they would have to push that forward. You can actually, as a real estate professional, then take that loss against your other income. So definitely a useful tool, but definitely make sure you keep track of hours, make sure you read those IRS guidelines, and make sure that you do meet those requirements.
Can you give us a simple example for those that maybe it went over their head, what that means, being able to take those other deductions against their losses?
Yeah, perfect. So let's say, again, using that same number, you're a real estate professional. You made $175,000.
Yeah. And if you don't have rentals, how much are you paying in taxes, just average? I know everybody's different, depends on their household, but
Yep.
if you could just guess, a real estate agent, let's say they don't have any rentals and they just straight up make 175 grand. How much on average do you think that they may owe to the government?
So let me just run some quick calculations for you. So I don't.
Tom's
And
a
I
numbers guy.
think,
He's got to run the numbers. I
yeah.
love it.
And I don't think this is a waste of time at all.
Yeah, I think it's really good.
People.
Yeah, perfect. So, and I can put in any number of scenarios. So, are we talking about a single real estate agent or one with married and kids? I can kind of run both. And
Let's just assume that there's a single guy out there, 35-year-old, doesn't have any kids or anything, and just wants to go get into real estate, makes a bunch of money as a real estate agent, and he tells himself, "I'll invest later. I just want to make a bunch of money."
yeah, perfect. So let me put that in real quick and let me show you the exact breakdown of basically what that would look like. So let me just adjust some of my numbers in here.
And this is why you guys hire a
Yeah.
tax professional, by the way, because people like Tom can do this.
Yeah, he's not guessing off the top of his head.
Right.
He's using a computer.
Mm-hmm.
And I'm sorry, let's call this guy a 25-year-old. Let's be more realistic. If he's 35, he should have a wife by then.
Guy or girl, it doesn't matter.
Or girl, sorry.
Yeah.
The age won't really factor in unless they're over 65. That's when the big difference on here where it would kick in or not.
Which you can start in real estate if you're after 65, by the way. Like, there's the only time it's too late is when you're dead.
Yeah, but still, if you're over 65, just get into this business. Good luck.
Mm-hmm.
Yeah, well, the software is loading and I'm pulling that up. That kind of good segue to something I wanted to talk to you guys about is some estate planning a little bit when it comes to age. So let's say you buy a property and let's say at the time of purchase it's a $500,000 purchase. You hold onto the property until you die, and then at that point you want to leave that property to your heirs. I definitely think a trust would be a great option. Even if you have LLCs, or entities, the trust can be the owner of that stuff. But if you did a little bit of estate planning, and you want to leave that property to your kids, they get a step up a basis of date of death, and that includes wiping out any capital gains or losses on that property the whole time that you had that. So let's say you bought that property for 500, you then passed away and the property's worth 750. Your kids get a step up a basis of date of death, so they would never have to pay capital gains tax on that if they sold it within a pretty reasonable time period. And if they held it, they would basically start that basis of date of death and move forward. So, okay, so this person's going to get straight up killed. So, if it $175,000 net profit, that's basically gross profit. Let's say they're at 250. They have enough expenses and write-offs that now their net profit is 175,000.
Okay, so they brought in a total of $250,000 in commissions, but after all their expenses, which would be, maybe office space, splits with their broker, something like that. Is that what you be? Or
Yep, and that could be anything. That could be your dues, your commissions that you pay out, could be your prop stream memberships, it could be your advertising. You could have
you're an assistant, you're paying maybe salary.
yep, Yep, exactly. Any of those things, your net profit is now at 175. So for a single taxpayer, no kids, so their effective tax rate, they would be in the 24% bracket. They would be paying taxes on 13.91%. And then they would have that self-employment tax that kicks in as well.
Okay, so we're assuming this person's also the self-employment. Oh man, we forgot about that.
Yep.
Yep, this is straight up sole proprietor. They're going to pay $23,000 in self-employment tax. And so their overall federal tax liability on the 2022 tax return would roughly be $47,000 off of that 175.
Wow.
50K. Yeah. It's a lot of work.
It's like 33% of your profits, right?
Yeah. Yeah, and that's off your net.
Mm-hmm.
Yeah, that's one year. I mean, that's like working a couple of months just for the government.
No, exactly. So let's say same exact scenario, but we're going to pay ourselves $100,000 on a W-2, and we're going to convert this to an S corp. So same net profit. We had $100,000 of W-2 wages, and then we took $75,000 as the net gain in our S corporation. So same exact scenario. Remember, you are going to pay FICA tax when you pull out that salary. So you're still going to pay all that stuff. But the difference is same exact scenario, single taxpayer, everything else. Your tax still in the 24% bracket, but your effective tax rate now drops to 16%. So instead of that 47,000 that you paid, your overall tax burden would roughly be 30K.
Okay.
Yeah.
So you're saving almost 20 grand, 17,000, 20 grand just by setting up some entities, which I don't know, what would it cost somebody to set all this up? $1,000?
Yeah, so roughly around $1,000. Yep, I would say roughly around $1,000 would be kind of a good thing. You can do it on LegalZoom, or some other organizations. You can do it yourself. My recommendation is definitely see a professional when setting it up. One of the reasons, or the main reasons why, is a lot of times people will come into my office and be like, "Hey Tom, I've been doing a lot of research online and I found out that I should be an LLC, and so I set up an LLC." So I said, "Perfect. Let me see your articles of incorporation." "All right, I filed it with the state. Here it is." "Okay, let me see your EIN number." "My what?" "What about your operating agreement? What about this? What about that?" And so what happens is they start the process but never finish it. And the problem with setting up an entity and not finishing it is going back to what we talked about in the beginning of this podcast. One of the main reasons why you set up an LLC is for liability protection. And if you're not going to have that liability protection and anyone can pierce that veil, then you're really doing yourself a disservice. Plus, you can, if you're mixing it and stuff like that, there can be some tax implications that are negative as well. So making sure it's done and set up right is a great way. I partner with an attorney out of Reno to set up all mine. It takes about 10 days and he can do it in all 50 states. So definitely see a professional when you get that done.
That's super solid advice, Tom. And that stuff, like, I've been in this business only a couple of years, but I see a lot of people set up these LLCs or these articles and stuff. And like you said, they set them up, 50%, 75% of the way. I think people are afraid to pay a professional right now. And it's a weird thing because if you pay a professional, that takes the liability off of you, right?
No, for sure. And well,
Yes and no, right?
yeah, no, for sure. And one of those things, going back to setting up entities, a good topic that I like to talk about as well is the importance of a buy sell agreement. So, a lot of times, people, especially in real estate, let's say, "Hey, I found this property. I want to partner with somebody on this specific property and they're going to bring in the cash, I'm going to bring in the labor, or we're going to bring in cash together, we're going to flip it, and everything is good, and maybe we do this long term. The problem that a lot of people have is they don't do buy-sell agreements. Buy-sell agreements is something that I recommend always when you set up with a partner, because everything's cupcakes and rainbows and blue skies in the very beginning of a partnership or an entity. And then what happens is things go sideways. What happens if your partner starts doing drugs and you need out? What happens if they pass and now they're leaving it to their wife, who wants to now take ownership percentage of the company and help you manage the company? What happens if this? What happens with that? With the buy sell agreement in place, it kind of lays a lot of that stuff out in the beginning, so then you're spending a little bit of money for an attorney to set that up in the beginning, compared to spending a lot of money in attorney fees later on when things go south.
Are you taking
Yeah.
note?
Yes. But too late.
No,
Yeah.
but like I think you're right, Tom. Like just people are so weird about paying that professional, and I want to like just really stress that like the couple $1,000s that you pay in advance for professional help on setting up your entity and going through these what if scenarios and going through the worst case scenario. Okay, if X partner dies, or if X partner starts drugs, or if X partner does this, it all kind of funnels down. Then we go into this transition, right?
Yeah, doing this for 25 years, I've seen all of the horror stories and the different things that have happened. I've had owners that have forged other partners' names, and they've literally had to have criminal attorneys come in. I've also had ones where the partner has started doing drugs, they've been driving business out. I've also had a client that basically it was a husband and wife, and a husband and wife who owned a mobile home park. And basically, what happened is the owners died, left it to their kids. And how it gets complicated is the first couple had 3 kids together, and then they passed separately. And then the other couple got divorced first and then had kids separately. Fast forward 40 years, there's no buy sell agreement, and none of the partners like each other because of divorce situations and stuff like this. And so now you have entity that they want to sell that's super profitable, but everyone hates each other. Everyone's trying to, they have to have majority ownership to sell. Had they had exit strategies on some of that, they could have been done with this a long time ago. Instead, you know, $250,000 in legal fees, and still trying to get rid of the properties.
Wow.
Yikes. Yeah, an ounce of preparedness will really solve a lot of problems in the future. Yeah.
Yep.
Hey, so going back to this example, can we throw one more thing in the mix? So we started off, we got this 25-year-old. He's a hustler. He's just selling real estate, makes 250 grand gross income after all expenses, nets 175,000, but he's paying approximately close to 50 grand to the government, right? 47,000 ish. But in the second scenario, he sets up an entity. He also makes himself a W-2 employee, and he's going to bring that tax liability down closer to potentially 30,000, right?
Correct. Yes, sir.
Let's add one more thing in the mix since we're talking real estate.
Yep.
Let's say instead of, he's got this money set aside to pay all these taxes. What if he just buys a house and uses 50 grand as a down payment on a $375,000 home? He's a real estate agent, so he can negotiate to get a little bit of, maybe he gets a 6% commission all to himself to help buy down that 20% down. The 20% of 375 would be 75,000. Maybe it can be closer to 50,000 if he uses his commission. What are the potential tax liabilities in that scenario? Let's say he buys a rental property. He puts 50 grand down and starts making payments on a loan. Has all these, he buys a new construction property, so he doesn't have any improvements to make right away.
For
but
maintenance or anything.
can we kind of run that scenario and see what he'd be looking at? And I know there's a lot there.
Yes. So basically, when you buy a house it kind of opens the door. Like if you're buying a primary residence, it kind of opens the door for itemized deductions conversations compared to taking a standard deduction. So the way our system works right now is, again, I'm going back to the 2022 tax return. So if we took an itemized or a standard deduction for a single taxpayer, they're allowed $12,950. So basically, when you're buying a house and you're trying to basically race against that standard deduction, you're trying to get above and beyond that. So then those tax deductions will be beneficial to you. A few years ago, before the Tax Cuts and Jobs Act, that number was about $6,000. So a lot less hurdle to get over compared to today. So for a single person, it's 12,950. So basically, what you do is you take any medical expenses, 7.5% of adjusted gross income. Anything over that would be a deduction towards this itemized number. Then you take real estate tax that are paid. And a lot of times, especially in the first year of somebody buying the house, they either do their taxes themselves or they don't go to a professional. A lot of times they miss the HUD 1 and the closing statement. So a lot of times when you purchase a house, there's prepaid real estate taxes in there, prepaid interest in there. There's a lot of times there's points that can be either taken or amortized. And a lot of that is in those HUD 1 closing statements that a lot of people gloss over. Those aren't even reported to the IRS. So the IRS for years has sent me letters saying, hey, you claim this expense, we never got record of it. I'd slap that HUD 1 down with a letter and basically be able to write that off. So going back to that, so real estate taxes, any supplemental taxes that are paid, DMV fees, real estate supplemental or personal property tax, you can take any of that stuff. And then you can take mortgage interest as well. And then gifts to charity. And there is a few other ones such as casualty loss, but those are the big ones. And then you add all those numbers together. And if you're over that roughly $13,000 threshold, then yeah, that'll chunk down that income. It won't affect your self-employment income. That will still be on there regardless of which way.
And we're talking a rental property, not just buying a house to move into, right?
Right. So rental property is a different ballgame. So let's say this person in our hypothetical situation is not a real estate professional. They would meet the requirements that they could not deduct any of that rental losses if there were. So with a rental property works a little different than if it's your traditional main home. So with that, you're allowed to take the rental income. You have to pick up the rental income, and then you basically offset that with any expenses you have. So going back, we can still take the real estate tax, any points, we can still take the interest, but now we can also add on insurance for the house. If there's hazard insurance, or if you have earthquake insurance or flood insurance, any of that stuff you can deduct as well as travel to the rental property itself. Any expenses that you incur, HOA fees, if you have utilities that you're paying, a lot of times people pay the water and sewer or the water and trash. So then that way there's some, making sure that the rental property doesn't get sideways. Any landscaping that's done, any pool services or any other things that are done, all of that stuff is deductible off of that income. And then one other thing that you can do is then you can take depreciation off of that property. So basically, the way the depreciation works is if it's a residential real estate, you take the property's total value over 27 and a half years, unless you do a cost segregation. And then basically, what we'll do on that point is take the depreciation off of that income. Yep, yes, sir. Yep, good point. You do take off the land, can't depreciate the land. So then what happens a lot of times on rental properties, even if it's cash flowing, and good underwriters and lenders will know this, even if it's has a good solid cash flow, a lot of times on paper, either on a Schedule E on your personal or on a partnership, a lot of times on paper, those will have a loss. And so let's say the real estate agent here has a $10,000 loss. Now, what we're going to do is we're going to shrink his income because he is a real estate professional.
And that 10 grand could easily, sorry to interrupt, but I mean, if you just take the depreciation alone, that's almost 11,000 on a property like this. If they buy a property for 375, take out about, 75 for the lot and then depreciate that building, there's almost 11 grand right there before any of the other expenses.
Wow.
Yes, sir. Yes, sir. And so on this one, if it was an even 10,000, it would roughly be about a $3,000 tax savings for having that rental property.
And this is for a real estate professional?
Yep. And if you're not a real estate professional, that $10,000 loss gets pushed forward to the next year and to the next year and to the next year until they relinquish that rental property or their income dips below that 150,000. It's called passive activity loss.
So if you just had to guess, this fictional character, let's say he's a real estate professional, he takes your advice, he becomes a W-2 of his own LLC, bringing his tax liability down to 30 grand ish. If he does buy one rental property that year, what could his potential total liability then be at that point?
Yeah, so in that scenario that we used with the 10,000, he would roughly be paying about 27,000 in tax. First year or two of a rental property, a lot of times the rents aren't there. Maybe the property needs to get renovated or updated. All of those things can be deducted. Maybe they put in a new washer and dryer. Maybe those things get deducted. Maybe they have to pay a lot in advertising. So a lot of times the first year or two of a property, there's definitely some huge losses that can be utilized and definitely shrink an income for a real estate professional.
Okay. And then let's say, 10 years goes by, he's making the same income and he buys one property every year. Maybe by year 10, he doesn't have any tax liability. Is that possible?
That is possible. I don't think that would be great because at that point, the problem that real estate professionals run into is they're doing the exact thing you're talking about. They're killing it their first couple of years. Well, they kind of hit this wall at some point, and that wall basically is debt to income ratio. And the lenders start looking at it and, hey, are we over leveraged? Are we, what are we looking like? So that's where good tax planning and strategy and sitting down with professionals as well as with a lender, which is something that we do, is sit down with a lender and kind of come up with a roadmap and a game plan of what's going on. And maybe some alternative lending perspectives, such as asset based lending or hard money lending or finding someone. But when they look at an overall picture on some of those properties, they're looking at cash flow. A lot of times, lenders will add back amortization, they'll add back depreciation, and so that'll factor into it as well. So, again, each situation is going to be different, but it's one of those things that strategically you have to look at. And one other thing that a lot of lenders will run into, at least from a lot of my clients' perspective, is moving from a traditional lending of real estate because the next step is, well, I want a commercial building or I want a building with 5 doors. Maybe it's an apartment complex or something like that. Well, that is a different style of lending than the other way. So trying to breach that door to move on to the next level is definitely something that you need a strategic game plan because a lot of lenders are hesitant to lend for those type of properties unless you have experience with those types of properties already.
I see a lot of people, obviously, like kind of what you can talk about with switching your strategy a little bit. A lot of people will start with their, single family rentals. They'll sell a few of them and they'll 1031 them into an apartment building or something bigger that allows them to basically forego the taxes on that, correct?
Yeah, so 1031 exchange is an awesome tool that can be utilized. Basically, for those who don't know, a 1031 exchange is an exchange of like kind property. The rules used to be a lot different than they are now, and to me, they're a lot favorable than what they were, which taxes being favorable, that's kind of a,
That's a big
one of
deal.
those things. Yeah. So basically, the way a 1031 exchange work is it's an investment property to an investment property. It has to be real property to real property. Cannot be your main home, can't be something else, but you can go exactly what you said. You can go from a residential real estate into a commercial. You can go a commercial into raw land as long as it's going to be used for investments. You can go from raw land to a farm and anywhere in between that. So it's one of those things. What happens is exactly what you said is you defer all of the capital gains, the depreciation, recapture, and everything, and you roll that into the next property. So there are rules in regards to that. You have the 45 180 rule, and basically the way that works is you have 45 days to select up to 3 properties, and then you have 180 days to close on those properties. And the IRS is very clear. You have to close on one of those properties. So let's say one of the 3 properties, a lender pulls one off the market, one of them burns down, and you can't get the financing on the other one, then your 1031 exchange is sunk. So make sure you do your due diligence, find property, at least one of them that you know you can close on for sure, that's kind of a sure bet. And then you have 180 days to close on that property. One of the things that a lot of people do is they don't talk about wanting to do a 1031 exchange with their real estate agent or with their escrow office. And so they'll receive the cash in their hand and their 1031 exchange is sunk anyway. You have to use a facilitator. They put the money into a trust account. The trust account sits there and then they relinquish the property in there. One other thing is you can use the 1031 exchange for buying a flip, or not a flip house, but a house that needs a lot of work. So how that would work is you would buy the house, you would basically use the escrow office as like a building loan, and you would take draws to build on that property. The caveat is you still have 180 days to fix up all of that stuff. So any money that's still left in that account that wasn't used for the investment, the receipt that gets put into your hand is what's called boot, BOOT, and that is taxable at long-term capital gains rates.
Gotcha. And
Where did
just to clarify real quick, from the day you close on your first property that you are going to be 1031ing, that starts the clock. Is that correct?
Yes, sir. Yes, sir.
Okay.
And you can actually, it's a little bit less common, but you can actually do what's called a reverse 1031 exchange. And you can actually buy your property first. You still have the 180-day rule, but you can buy the property first and then roll that money into that other property. It's a little bit more complex, but it's still something that you can do. And then one other thing I definitely always like to recommend is when people are deferring these capital gains, they're like, all right, well, let me just move into that property later on and I'll use the $500,000 exclusion for the main home. That's right out. The IRS has full teams that basically look at that and then make sure that you're not using that. And the court cases that have won where people have actually won in a case like that are very few and far between, and it's basically they're hard up. There was a life-changing, altering course. They had to move into the property. There's no other way. And then it comes up with a whole nother slew of problems that they have. So going back to that, it's strictly investment related rental properties. But let's use this. Let's think about it. We could basically take a property. We bought it for 100,000. We have $500,000 of stuff because we've had it for so long. And now we basically 1031 exchange that into a new property. And then down the road, we'll exchange that into a new property, and that one into a new property, and that one into a new property. Or we just let the money sit on the table and let it ride. Let's say that $100,000 initial investment is now into $1 million house over 20 or 30 years. You can then leave that to your kids and they get a step up a basis a day to death, and those capital gains taxes that were deferred that whole time get wiped off the table.
Just defer it until you're
just
dead.
gone. Yeah. And something else about 1031s I just want to throw out there, since a lot of real estate agents listen to this show. I still have yet to ever, I've been doing this for 13 years now. I don't think I've ever had a 1031 buyer back out. They are the strongest, most solid buyers out there because they don't have any other options sometimes.
Right. They know
like
that if
maybe
they
they're
screw
out
up this 1031, like they're paying
Yeah.
the taxes on it. So they're
And-
committed to buying most of the time, right?
Yeah, and I'm talking about the 1031 where they've already sold their other property and it's not contingent upon a sale of another property. But if they've got 1031 money sitting in with a custodian, they almost always will close on that transaction. They're typically very solid in my experience.
Yeah.
And one other cool thing that I didn't talk about is it doesn't have to be one property to one property. You can actually do multiple properties into one property or one property into multiple properties. So as long as that money is utilized for other investments, that's a great strategy to use.
Can I ask just one question on that? So say you're going to sell multiple properties, Tom, right? So say you've got one closing on the 5th of November and then two that are still on the market. Does the timer start on the one with the 5th of November? And then if you sell your second property, does that restart the timer?
So if you're utilizing it to buy one property, it's that very first timer on that one. Basically, you have to close on the new property within 180 days of whenever that first one is. You're basically, and that's what Nick was saying, is you're on a ticking time bomb. So those make strong buyers when they're basically, you know, have to close by a certain date. Like this has to get done or else they're going to get hit with a lot of tax. So that makes them a strong buyer for sure.
Yeah, and they almost always, they'd rather buy like a marginal deal than have to pay taxes.
Yeah.
Yep, exactly. Because if that deal falls through, and let's say they didn't have one of those other three properties, let's say they only listed one, and this is that one, all of a sudden, it's coming down to that 170 day mark. Maybe the underwriter is starting asking for more stuff, maybe, this and that. All of a sudden, it's like, hey, it needs to get done now. I don't care what it is. We don't want to pay tax on it.
Sure.
Okay, great. All right, Tom. So let's take a few steps back, if you don't mind, before we get deeper. For those people that are just starting out as they want to be a real estate investor, clearly it's easier to get started organized now versus later. What would you recommend for somebody that they want to get started buying rental properties or flipping properties? Should they get an LLC right away, or should they get a trust right away, or should they get both? Should they have separate LLCs for, doing flips versus holding rentals versus maybe running if they decide, hey, I want to become a real estate professional, but I don't want to get my real estate license. Maybe I'll pretend to be a property manager and I'll I'll start a property management business. Like, I know I'm all over the place here, and that's why I need you to reel me in here, Tom. But tell me, where do you start?
Yeah, these are the exact conversations I have all the time. So, yeah, one thing I didn't talk about is shout out to my brother and my sister, because both my brother and my sister are real estate investors. My sister is a real estate agent slash wholesaler out of Tacoma, and my brother is a real estate investor who owns properties in 4 different states. And so when I was starting out my tax career, I kind of got thrown into this, and it's something that's only expanded and something that I found that I have a knack for and a love. And, it's a very awesome thing to get into. So when a client comes in, it all depends. Let's use an example of not just somebody who's a real estate agent, but let somebody who's self-employed or has a high-risk job where they have a lot of liability.
Let's say they're a contractor. Yeah.
Yeah, so let's say, yeah, exactly. So to me, if there's a lot of liability or risk in their job of lawsuit, then I do recommend maybe setting up an LLC and putting that property into that LLC, because their other facets of life basically are more risky. So I like to separate my risk. If there's a clerical job or something that's not very risky, there's not a whole lot of liability. A lot of times, the first rental, I would tell them they don't need to run out and get an LLC. But that's not always the case either, because what happens if they're in a high risk area where there's high crime, high violence? Maybe they're in some area that's not the best, or let's say, I believe in the city of Spokane, you can actually rent back to the government for homeless. So it's one of those things that if you're doing something like that, there's a lot more risk involved for that. So to me, I've have clients that have halfway houses as a rental. Again, that's something I would recommend right off the bat because there's more liability. But if you're just starting out, I would say no, keep it simple. Let's try and make the money. Let's try and keep rolling that money down the table. Let's just have a Schedule E. But that's a conversation that each person needs to have with a tax professional or an attorney to see what's the best option for risk mitigation and everything else. But once you start getting more properties and different types of properties, that's when I do think that LLCs come into a huge play. Because again, if we're doing more stuff down the table or down the road and there's more things on the table, then at that point, there's more risk. So, what I like to do is like kind property. So, if I have a long term rental, what I like to do is I like to group those ones together, maybe two or three, depending on risk. If I have a short-term rental, a VRBO, Airbnb, Hip Camp, any of those type of things, I will separate those ones from the long-term rentals because they're two different types of income. It's active income if it's anything 7 days or less, or you're providing amenities or something like that. It's considered active income and it's taxed differently than passive income.
Yeah, like an RV park.
Yep, exactly. And if you have bigger properties, such as an apartment complex or something like that, or let's say it's a dorm or a commercial building, those ones I'll usually separate completely by themselves because there's more doors for those properties, and that's where the risk comes in on that. So I do like to separate those ones. And then again, this is kind of a rabbit hole that people get into is, this one leads into this one, which leads into this one. And all of a sudden they have a bunch of different LLCs. And at that time, maybe it's worth looking at a holding company. And the holding company basically owns all of those assets. And going back to your original question, if you own real estate and you have small kids, you should have a trust. You should have life insurance. You should have a trust. If you own assets, you should have a trust, because the last thing you want is a probate attorney to come and take 40% of your assets if you don't have something in place. So, the way that works, if you have an LLC, the LLC's ownership is owned by the trust. So then that way, whoever is your beneficiary then takes over those percentages of that trust. So I definitely think that that's a great option. So starting out, maybe nothing at all except for maybe a trust, and then down the road, an experienced person with a lot of stuff, maybe it's a trust, a holding company, and then tree branches of LLCs underneath that. So again, you'll complicate and ramp up your life pretty quick.
Yeah. So, like, to give a live example, like Tom, you've seen my stuff. I don't know if you remember it, but it's a mess of LLCs, right? And there's no real protection other than just, these individual LLCs, but there's no real structure to it either. But would you think it might be wise if I had a trust that owned a holding company that then held all these LLCs?
So without getting too much into your personal stuff on that,
And I don't care, by the way. I'm very open about it.
I do think you're on the fence of maybe that being a great thing. I think a trust would be great either way, but having that holding company as well is definitely a good option. One other thing while we're on the topic of LLCs and stuff like that, one of the things that people get killed on a lot when they're trying to structure and everything else is they are owning the properties and doing all of the construction themselves. Well, you're not paying yourself for construction, so I do recommend, and there's a lot more liability in the construction side than compared to holding. So I do think those two things should get broken apart, separated, and then basically you would pay yourself to flip that property, and then that way you can write it off and everything else. Another great strategy for having a lot of properties like this and you're doing it yourself is set up a property management company and then pay yourself to do that. That's a good way to kind of centralize the money throughout these things. And one other thing that I never want to not say is make sure that if you're switching to an LLC from a individual, that you contact your mortgage company and have that open conversation with them and say, hey, I talked to my attorney, I talked to my tax guy. They said that it's a great option for me with the way I am to limit the risk to put this into an LLC, but I'm still going to personally guarantee this note. The reason why is because if you do this without notifying your bank or your lender, they can call that loan due. And next thing you know, here you are trying to come up with $500,000 to basically keep your property.
Yeah. And there is one exception to that. If you do transfer it right into a trust, isn't that one little safeguard that you have?
So trust is a little bit different because that's still you. An LLC is a completely separate entity. Well, trust is as well, but different when it comes to this for sure. So again, just have that conversation with them. If you need a note from your tax professional or your attorney, and just, they want the assurances that that mortgage is still going to get paid, that it's not going to get handed off and just disappear.
Yeah. And then there's more to it than that. You got to make sure that the insurance is written up correctly and that, that they list the additional insureds on there as everybody involved, including the LLC.
Exactly. Yep. And including the lender and everyone else. Yes, sir.
All right. Gosh, we're already over an hour. Maybe we should wrap this up. I had more questions, but maybe we can save it for another day.
Yeah, I think we should get Tom back on definitely and talk more for
Maybe
sure.
we'll do part 2, and then
Yeah.
if any of the listeners out there, if you want to send some questions to Jeremy and Nick, maybe we can answer those live next time too. So I don't mind that
That's
either.
a good idea.
Yeah, let's
put in the comments on the YouTube comment, or I guess can you comment on the actual podcast?
What we're gonna do too, Tom, is I'm gonna have if you're okay with it, of course, give people a way to reach out to you if they have any questions as well, because I think if people want to talk to the professional, they should really go right to the horse's mouth for this stuff. And like Nick was saying, like I could talk to you for hours just about this stuff because you're easy to talk to, you're a wealth of knowledge, and we would definitely love to have you back on the episode for sure.
Yeah.
But we are gonna wind down with just a couple predetermined questions, if that's okay with you, Tom.
Yeah, perfect.
Cool. First question's pretty simple. So, if you had one business or real estate investing book you recommend every single investor or entrepreneur read, what would that be?
Game of Thrones.
Honestly, I mean, you're not wrong. You're not wrong.
I've seen his bookshelf.
Any fantasy books. To be honest, that's a hard question. There's so many out there that I like. My brother would kill me because he basically reads one real estate investing book a week. I don't know which one would be my favorite, to be honest with you guys.
That's okay. How about we ask that question next time too, and we'll see if we can get an answer out of you.
Stay tuned till part 2.
Yeah, so stay tuned for part 2 for the juicy details on that. The next question, though, is one I'm very interested about your opinion on, Tom. So, if you had $30 million gifted to one of your bank accounts, what's the first thing you would spend it on?
Well, the first thing I want to do is see if the taxes were already paid on it and see where this money. How did this money get into my account? That's the.
I knew you would bring that up.
Yep.
But to be honest, if you were to ask me this question a few years ago, I would say I would jump into a giant commercial building or commercial real estate. But that number, that has shifted a lot for me because since COVID, everyone's working from home. Look at our area that we live in North Idaho. Everyone is moving here and working remotely in California. They're working remotely from Texas, from Washington, from New York. And so the use of commercial real estate in a large avenue like that, I don't think is really where it's at. So to me, I think that if I were going to do that in our area, I think storage units, places to keep boats, RVs, stuff like that. But one of the things that I really like that I would love to do is old folks' home and assisted living. The reason why is because those baby boomers are coming due to getting to the age where they need that assisted living, they need all of that kind of stuff. And to me, there's not enough for the wave that's coming. So to me, it's kind of a two-parter because you invest in the real estate and then you invest in the assisted living. So to me, it's kind of the best of both worlds because if you ever need to get rid of the assisted living, you want to do something else, you still have that real estate asset too. So that's where I would put my money if I had it.
Yeah,
That's
absolutely.
a good answer.
I like that. The next question for you, Tom, is if you had one piece of advice to give a real estate investor, looking for their maybe first or second deal, what would that be?
Talk to a lender and talk to a tax professional ahead of time. Don't just try and do it on your own. Just say, hey, this is my tax return, and away we go. Because what happens is if you do that, it's already too late. Your taxes are already done. They're already, you didn't come up with a game plan. Coming up with exactly how much you need to show in income, how much you need to qualify for a house, what exactly cash flow you need to have, what is your debt to income ratio, what is your stuff. So talk to your lender, talk to your real estate agent, talk to your tax person, get everyone involved ahead of time, come up with a map, and then do that. So many times my clients or people who with other people, their accountants charge them way too much money to basically say, hey, what's your advice on this? The way our firm's set up is we don't charge for that because we want to walk with you hand in hand to make sure that that's done and what your goals are being met. So again, talk to people. There you have people in your corner. So then when you're making that first baby steps, you have a map of exactly what you want to do ahead of time. So that way you're not floundering down the road. And even if you get that, and then what are the next steps and you don't know what to do and should you hire a property management company, like have a game plan ahead of time.
I think that's really good information right there. Talk to your professionals before you get started. That way you can set up your roadmap for success. I think that's great. Next question is a very easy one for you. What do you like to do in your free time, Tom?
Sure. I have 4 kids, so my free time is pretty limited. I have a son who's in hockey, and then I have 3 girls who are in competition cheer. So spending time with them. But one of the reasons that drew me to North Idaho is visiting my wife's family up here is outdoors, man. Like, where can you go and go hunting or fishing or kayaking or hiking, camping? I mean, it's literally anywhere you go in any direction, and I just love this area. So just being outdoors, shooting guns, like anything outdoors out here is, for me, fishing to hunting to hiking, all of that.
I love it.
Nice.
Last question for you, Tom. Where can people find out more about you? So if they want to get in touch with you or, consult you for your tax advice, because you're a professional, obviously, where can people find out if you're on social or send your deets?
Yeah. So the best place to get a hold of us is we are on social media, but the best place to get a hold of us is directly through our website at tom@taxrfs.com.
tom@taxrfs.com. We'll put that in the show notes as well, too. So
Yeah, perfect. Thanks, gentlemen.
yeah, Tom, thank you
we
so much.
appreciate it.
Like I said,
And
we'd love to have you back on as well. So
yeah, maybe we'll do a part 2. I don't know, in a few weeks or so, maybe 3 or 4 weeks.
yep, we'll schedule it after. So
All right, perfect. Yeah, we'll make sure it's at the most inconvenient time. No, I'm just kidding. Right after January is when you're pretty available, right?
yeah.
If you could do March 15th, that would be great.
Yeah. We're going to set you up for as many interviews as we can, actually, from March 15th to April 15th, if that's okay. We're just going to take all of your time. You're not busy, right?
Yeah, sounds good. No, we'll get it done before the end of the year.
All right. Well, thanks, guys.
Awesome. Thanks, Tom. Appreciate you.
We'll see you around. All right. Thanks for hanging in there, everybody. We'll see you next week.
Thank you so much for checking out the Investor Shed podcast. If you enjoyed your time, make sure to leave a 5-star rating and review on Apple Podcasts and Spotify. Follow along on YouTube, TikTok, and Instagram at The Investor Shed for shorts and promos about each episode. Do you want to be a guest or know someone who has great real estate investing advice and stories? Reach out to us at theinvestorshed@gmail.com.